Karen Veraa is back with us from BlackRock, head of iShares U.S. fixed income strategy. So Karen, are we starting to try and like game out political outcomes and what it means for the market? Because I am hearing some chatter about the way yield spreads widened out here the last couple of days. Any thoughts on that?
Yeah, I think we're seeing a lot of investors who are wanting to be concerned about market volatility going into the fall. So I think there's still a big opportunity in credit. We're seeing yield producing, income producing assets are at the highs that they've been in really a generation, and even investment grade credit still yielding about 5.5%. So we are seeing investors who are really rethinking some of their fixed income allocations and trying to size up how much they want in income versus treasuries.
Is it economic data that's driving that, or is it trying to predict fiscal policy 6 months from now?
I think a lot of it's still economic data. So we had the May PCE print came in a little bit flat, which really shows some of that pressure on inflation is abating. Everybody's really looking at Friday's jobs report to try to make sure that are we still going to grow payrolls? Is there going to be elevated pressure on wages? And what is the Fed going to do in response to that? So I think we've really seen the Fed funds futures market push out that first cut to possibly November, but then that puts us right smack in the middle of the election. So I think to help with that, investors are really putting on a barbell right now. We're seeing a lot of flows in ultra short duration bond ETFs like SGOV, but we're also seeing some investors add longer duration like TLT, really to hedge out some of that equity market risk and try to make sure that they do have duration just in case rates come down.
Okay, so kind of playing bonds for a more traditional kind of risk-off scenario in case stocks pull back, equities down, bonds up.
That's right. We've seen some model portfolios rebalancing and adding some big allocations to longer duration fixed income ETFs.
With the gap in the Fed calendar, no August meeting, how do you think that kind of gives us, how does that affect the window here for a couple months where there was like day to day, week to week repricing of Fed expectations, but now are we just kind of like fixed at September?
Yeah, I think a lot of investors are just going to wait. It's going to be a wait and see market. Investors are simply going to make sure that they have their asset allocation back on track. We're still seeing about $6 trillion sitting in money market funds. And we've been working with financial advisors who are maybe tired of rolling T-bills. So we've seen people coming to maybe ultra short ETFs because by the time the Fed does start to cut, a lot of those prices have moved in anticipation of that. So we're encouraging people to just step out of some of those money market funds, ultra short exposures, and try to add a little bit of duration back into portfolios. I think that 3 to 7 year part of the curve is still fairly attractive. However, we're also seeing a different camp where people are looking to floating rate securities, whether it's bank loans, whether it's floating rate notes, or even treasury floaters. That's been a way to just to hang out in that inverted yield curve at the very front end and just wait. And if the Fed is higher for longer, actually floating rate could be a nice way to add some income and diversify out cash positions.
What are the sort of possible scenarios you see when you think about the yield curve and the possible outcomes? Is this basically cuts and steepening the only way we get that? Or is it possible still we've got like another wave in the economy here to firm us up? Has hope been dashed on that front, or how does it look in terms of kind of the possible outcomes?
I think our base case is that this is going to be a higher for longer cycle. It's going to be very different than what we've seen the last couple of Fed cutting regimes because inflation is elevated. So we're not going to get down to that 2% range anymore. We're going to see the Fed taking a very measured approach. And they're also looking at the jobs data. So if they're still able to grow the economy, if we're seeing other risk asset prices like stocks continue to trend up, I think they're gonna keep it higher for longer. Additionally, corporate balance sheets are not under pressure with these higher rates. They took a lot of the low rates during COVID to really term out maturity stacks. So in fact, only 10% of corporate debt is coming due before 2030. So the higher rates have not affected corporate borrowers as much, simply because they don't need to refinance in this environment.
Okay. The expectations for this rest of the year also, though, include a debt wall some are worried about. Some have described it that way. Some have argued that's not the case. When you look at credit, is there a key point in the timeline that we got to like get through, or how do you see some of those risks from a credit standpoint, particularly in commercial markets where there's a lot of refinancing that needs to be done?
Yeah, we still see credit spreads are hanging in there at pretty tight levels, so the entry point isn't as attractive as it used to be. But we are continuing to see investors using ETF wrapper as a way to gain credit exposure. Since 2022, we've seen credit asset AUM and ETFs increase by about 30%, where mutual fund assets have decreased by about 10%. So we are seeing more and more people are allocating to credit because you have that huge yield buffer. So even if we have more rate volatility coming in through the back half of the year, you've got 5.5%, 6% income that can help buffer that some of these credit risky assets.
Okay. You mentioned on the Treasury side where you're seeing flows short in and then some of the TLT. As far as credit goes, are there any particular strategies that are standing out as the most popular?
One of our most popular strategies has been our BlackRock Flexible Income ETF, the ticker's BINC. It's a way to navigate these higher yielding asset classes without having to overload investment grade or high yield. It's going to have a mixture of both and also pull in some other assets like bank loans and even European credit, where we still see spreads significantly wider than the US. So I think it's a way that many investors have been looking at their core fixed income portfolio and they want to add some diversified income with less volatility, and they've been using BINC to do so.
Okay. All right, BINC, there we go. Always appreciate the insight and refreshed with some tickers for ideas. Thanks for your time, Karen.
Thanks, Oliver.
Appreciate that, Karen Veraa, head of iShares U.S. Fixed Income Strategy at BlackRock.